All right, here we go. We have the Fed Day on today's hot sheet. We're going to be covering the prepared statements from Jerome Powell, as well as all of the questions asked. Those two things we break down better than anybody. This is your 24-hour look back on that decision and how it impacts housing. We also have unemployment reading for today. Today is Thursday, March 20th, 2025. I am Byron Lazine, and the hot sheet starts now. All right, so much going on this morning. There's so much data coming in. This is the big Fed day. I was to break down everything that Jerome Powell said and all of the impacts that it has on housing. There's a lot of words that are obviously back. Okay, transitory. Remember that word from when inflation first started, and Jerome Powell and the Fed said, "Oh, inflation is transitory. We think even though we just convinced Congress to shove another $2.3 trillion down the throats of Americans, even though they don't need it because COVID is completely over, we just think that inflation is transitory, like it's going to go away, like the wind. It's going to be windy one day and beautiful, no breeze the next day." Obviously, that wasn't the case. Transitory, though, is back. Maybe not, though, in the way that you think. I'll break that down. The other thing that's back, the word uncertainty, probably used, if it was used 100 times yesterday, it was used 200 times. So uncertainty, the guy that's supposed to have the answers, Jerome Powell, doesn't seem to have any of them. I'll tell you exactly what that means. And then now you're hearing things like stagflation and recession. So all of these things are back. The Fed made their decision yesterday. We knew it was coming into yesterday. It was a 99% or 100% chance that obviously there was going to be no rate cut. There was no rate cut. What we're going to do here, though, is break down, what were the questions that were asked? What are the projections? They came out with their projections every 3 months, they come out their projections on the economy and what rates are going to look like in the future. We're going to break those down. And then we're going to pick apart everything and how it relates to housing. So we've sifted through, BAM has sifted through all of this data. We have all of the timestamps prepared for you. All that stuff is available for you inside of BAMX, so you can take a look at it there. I see, as so many of you guys are already doing, I see you're jumping into the live chat. Wherever you may be, let me know which market you're tuning in live from, and love to connect with you there. All right. Let's start here first with the press release. The decision was to obviously keep the federal funds rate at 4.25% to 4.5%. The federal funds rate is the overnight borrowing rate. It doesn't have that much of an impact on the 30-year fixed rate. Obviously the 30-year fix is going to follow the 10-year. Housing circles around what's going on with the 10-year. Okay, the 10-year is everything. The committee has re-emphasized its two-goal strategy: maximum employment and inflation rate at 2% over the longer run. So no changes there. They have their dual mandate from Congress. Unless Congress were to change their goals, their mandate, they're not going to change it. So they're focused on that, of course. The summary of economic projections. So they released that statement, obviously the press release. Then they released their summary of economic projections from meeting over the last 2 days. Okay, we're going to get into these economic projections. Then we're going to go to obviously the Q&A, which is where the market is watching the most. Okay, like what's the census? What's the tone of where the market should be going in the future? All right, so this was released before those comments. Okay, so the FOMC meeting, which again was held the last 2 days, submitted their projections. These come out every single quarter. They're talking about GDP, the unemployment rate, and inflation. And so they project out on a three-month basis. Every 3 months, they project out on a 2-year basis. Okay. So all the projections are based on the information that they have available at the time of the meeting. All right. And so there can be some differences. You haven't seen You haven't seen much differences. There are some differences here, though, on what some of the committee members. We're going to look at the dot plot, as they call it, on where the rates are going. The federal fund rates are going to go, and there was some larger differences than we've seen in the past. All right. So here are the projections, and they've moved a lot of these down. Okay. Look at this December projection. I'll just zoom in on this so you can see it. This will be available inside of BAMX, so you have an easy place to grab it as well, obviously. School.com/BAMX. The real change in GDP right now is 1.7 is where they're looking at it. The December projection was 2. So in December, 3 months ago, the Fed committee believed that, okay, the economy is going to grow at 2.1. That's 0.1 over where they want to get inflation at, inflation down to 2. Now they're looking at, wow, 3 months later, they've changed their mind. The economy is only going to grow in real change in GDP at 1.7. They only have it at 1.8 next year, and then 1.8 in 2027. So an economy that's still growing, but not growing at the clip of 3, 4s, and 5s that you're hearing. Like, one of the things the current administration ran on is getting energy prices to move down fast, to move those costs down on energy rapidly, to basically open up American energy and have a boom into the economy based off of that, which push these GDP numbers up considerably higher than what the Fed is projecting. So Fed is a lot more bearish on the growth of the economy. They still have it growing. They're not projecting recession. So that word keeps popping up. They say, basically, that they believe that the indicators of a potential recession have moved up, but not anywhere out of a norm. There's always an indication of a recession at any given time. Like if XYZ happens, we could go into recession. They're seeing some early data that would suggest you would move that risk parameter up a little bit, but within a normal level. So they're not signaling recession. They are still signaling GDP growth over the next 3 years, but it's well off of where they were in December. Unemployment rate they have moving up. That's good news for housing. Okay. We don't want to see people lose jobs, but the facts are, if we're at a 4.4, if we get to a 4.5, 4.4 this year on unemployment, we're going to see a 30-year fixed mortgage rate that moves down. And I bet you it's probably going to be a 6. If we're at that level, it could even be a touch under 6. So they're less, than where they were in December. They're less confident that they're going to be able to, keep unemployment down at these low levels of 4.1. And certainly that, in December, they had it moving up to 4.3 anyway. And by the way, the feds might want unemployment. They don't want it to get out of control, go over 4.5, get into, a recessionary, range, but they may want unemployment to tick up a little bit, because remember, that's very helpful for them to push inflation down if they get those numbers to kind of cooperate in a perfect balance of where we are today and where, somewhere between where we are today and where it would start pushing towards a recessionary time. PCE inflation, which is their favorite metric to cover inflation, not the CPI, which is what the investors like. They've moved up from 2.5 now to 2.7. So the Fed is saying we're going to have higher inflation this year than we thought 3 months ago. Why? It's the uncertainty. We'll get into that. Core PCE 2.8 off of a 2.5 December projection. So unemployment they think is going to be higher this year than they thought before. Our growth they think is almost a half a point lower. Economic U.S. growth, GDP, lower, unemployment higher, inflation higher. Okay, so really on every metric, they've pushed it closer to economic slowdown. That's where you're starting to see that stagflation. Well, geez, if we're growing at 1.7 and inflation's up over 2, that's where you're starting to see people write about stagflation a little bit. Okay. We'll see. Obviously, these are their projections. We're gonna get their projections again in 3 months. There's 12 members of the committee here, or maybe there's more. How many are here? There's you've got over 12. Haley, look up real quick. I thought it was 12. Maybe there's more people that participate in this dot plot. Okay. So this is what they call the dot plot. And this is where each dot is each individual. They don't give you the names because I don't know. They don't want, anybody to send them death threats or something like that, but they're not giving you the names of who picked what. The FOMC participants. These are their assessments of appropriate monetary policy. Appropriate monetary policy would be the target range or target level for the federal funds rate. Okay. Right now we're at there's 12 in the committees, which is what I thought. And so there's more people participating in this dot plot than just the people on the committee, it looks like. Right now we're between the 4.25 and the 4.5. So there's 4 participants that believe we're just going to stay there all year, meaning no cuts. Okay. Then you have the majority calling for 1 or 2 cuts. And then you've got a couple here that believe the economy is going to slow down so much that we're going to need, what looks like, 3 or 4 cuts. Now that's this year. Okay. Going into next year, you've got almost everybody that participated saying the federal funds target rate is going to be under 4. You still have 3 participants here in this dot plot that say we're going to still be over 4 on the federal funds. Bank of America CEO is saying, hey, we're going to have to, inflation's going to be higher for much longer. We're going to have to stay where we're at for the next 2 years. I saw that yesterday. So I guess this is where the Bank of America CEO would be sitting up here. By 2027, everybody has us under 4. You've got some that believe will be under 3 by that time frame, and then more so, even more driving towards 3 or under when you get to the longer run on the federal funds rate. There's so much uncertainty, as Jerome Powell said yesterday. The guy Powell, the Fed chair, that is supposed to know more and be able to guide the markets and the investors and breathe confidence into consumers. The guy that's supposed to know more than anybody said 100+ times yesterday that there's uncertainty, there's uncertainty, there's uncertainty. So all of the stuff that we're looking at right now could change dramatically before the end of the year. Okay. There are decisions on whether to hold steady or to make cuts. Now, they did say that they're seeing, the Fed is seeing 2 cuts coming this year. So right now, when we look at that, the majority of them say, hey, and we just looked at that on the dot, like there's going to be 2 cuts off of the 4.25, 4.5 range that we're at right now. But they're giving themselves an out to basically move in any direction they want by saying there's so much uncertainty, a lot of it driven by what's going to happen in tariffs. Jerome Powell also said yesterday during the question and answer that the members of the committee account for full retaliation on tariffs when they make these projections. So the projections that they're seeing, obviously they know when they made these projections for slower GDP, all these things, that tariffs are going to create retaliation from other countries. They've factored in his words, full retaliation. So obviously it remains to be seen, do tariffs create full retaliation? Are they negotiating? And that's where a lot of the uncertainty comes in, that a lot of this stuff can just change. The Fed says they're in a good position to basically go either direction, meaning make those cuts to maybe even more, depending on where the economy goes, or remain restrictive, which is staying at the 4.25 to the 4.5 level. Okay. Let's move into now the opening statements from Jerome Powell, and then we're going to go to the Q&A that we've carved out. All of the Q&A that we've carved out here relates to, obviously, how it's going to impact housing the most. Here's the prepared statements. They remain squarely focused on their dual mandate. In support of our goals, the Fed decided to leave policy rate unchanged. Economic activity continued to expand solid in the fourth quarter of last year. So this is one thing, and Powell gets asked about it. GDP rose at 2.3%. Jerome Powell gets asked about this in the press conference, like, hey, you keep talking about a strong economy. You keep talking about growth. You're talking about economic, activity. All of the hard data, as he calls it, is strong. Unemployment's low. GDP is up over 2%. Inflation is coming down. In the long run, we've seen inflation come dramatically down, and they see it in the future continuing to come down. All of the hard data, it suggests, and what Jerome Powell calls a good economy. Why do consumers not feel that way? Why are consumers pausing on major purchases like housing? We've seen the least amount of existing home sale activity that we've seen when you factor in labor and you factor in population ever. The last 2 years have been the lowest amount of sales, which impacts so many different segments of everybody's community. It impacts appraisers. It impacts lenders. It impacts attorneys. It impacts cleaning companies. It impacts handymen. It impacts moving. It impacts so many when there's less transactions, and we've seen the least amount ever when you factor in population and where we are with jobs. The last 2 years, we've seen, we're just existing home sales just barely nudging up over 4 million. When we see that, it impacts a lot of different segments of everybody's community. Remember, housing drives 17+% of GDP. And so, but Powell's asked about this question, like, you're saying this is a good economy, but consumers don't feel that way. Consumers are holding off big purchases. Consumers are in their confidence scores are saying they're not confident. They don't feel good. And they still go to the grocery store. This is the question, and I don't think we're going to get to this one. They go to the grocery store and they don't like the total on the receipt. And Powell, he actually said something that I think a lot of the reporters aren't getting. A lot of the reporters thought that, this new administration ran on, lowering inflation. That means that, the price of milk should be what it was in 2019. And Powell had to explain it to this nice reporter. No, that's not how it works. It's not how inflation, we're trying to slow down the prices from continuing to go up. Prices are always going to go up. Now that you're at the grocery store, this price level, kiss it goodbye. That's the price level of groceries now forever. We're not going back to 2019 level. Maybe you're going to start a farm. Little chicklets are pretty cheap. You can buy chickens pretty cheap, make your own eggs, and eat the chicken after if you want to. You can do that. That's going to be a way to cost money. But if you're going to save money, but if you're going to the grocery store, the new price level that has happened when you pump in 80% of US, you print 80% of our dollars in a 4-year or 3-year cycle. That new price level that's been created is here to stay. What the Fed is trying to do is stop inflation on top of this new price level. Think about it on like home prices, okay? Like home prices are still going up. They're just not appreciating at 20% a clip a year anymore. Like if home prices are just going up 2 and 3 from the new price level that they're at, that'd be one way to think about it. So yeah, the economy is growing. It doesn't mean that consumers, everyday people, are yet comfortable or wages have caught up to the new price level, which is not going away. The price level is not going away. You have to stop inflation from basically compounding the problem. All right, Haley, let's get into the timestamps here that we have. All of this, by the way, if you need, there's so much data here, and there's a lot of data that you'd have to sift through. Some of these PDFs are very long. Obviously, the press conference went, over an hour and all of that. If you want data to just be able to help, educate your consumers, your clients, just jump into, I'll show you exactly where to find it. Go into BAMX, go into Classroom, come down and click Hot Sheet Daily Market Data. go to today, and we've carved all of this out here for you, including the dot plot, including the economic projections. Okay. All of that's available for you, as well as the hot sheet show notes. So everything that we timestamp out is available in here. We're going to get into some of these video clips. So find that right inside of bamxschool.com/BAMX. It's all available for you. Like, one of the things that I'm, really, I'm hopeful that many agents are going to drive into the minds of the sellers is like the guy that's supposed to know the information, Jerome Powell, the Fed chairman, and his crew, his committee, his gang here, they have all now projected that the economy is going to get worse, not better. And they use the word over 100 times, uncertainty. What does that tell me? If you're waiting until the end of the spring market, you're just getting closer to where they feel more uncertain. What do we know right now about the spring market? Well, prices are basically in most communities across America at an all-time high. We know that if we go back into BAMX and we just show from Monday's show, March 17th, you can find this stuff, that we know that, page views on places like Realtor.com and Zillow are at the highest level they're going to be all year. For these next 3 weeks and the 3 weeks after this red line, the perfect week to sell. Like the next 6 to 8 weeks, page views, people's attention on RDC, Realtor.com, on Zillow.com, the places where 80% of buyers are looking for their homes, like consumer, home buyer, home shopper activity is going to be the highest level of the next 6 to 8 weeks. And by the way, right now, you have less competition than you do at the end of the spring when competition accumulates, active listings stacking up. And by the way, we have the lowest 30-year fixed rate in the last 4 months. You got to show consumers those charts. If you say realtor cliche things, if you dump a word salad on somebody's lap in a driveway, they're going to retain 15% of it. There's not as much competition right now, and it's a spring market. There's a lot of buyers. Like, this is the great time to put that. Nobody's going to retain that. Show them that data that I just showed you. Make it believable. Make it real. Wow, there's that much more attention online today than at the end of the spring. I would have thought the opposite, but I can see it. I can believe it. Oh, wow, we have the lowest 30-year fix in the last 4 months. That makes sense. Buyers are going to have more money. They're going to be even more aggressive. And we don't have any idea what's going to happen on the long run, because even our federal chairman, our Fed Reserve chairman, has no idea what's going to happen in the long run. All right, Haley, let's jump in here to, let's go to the first. If we go to, let me just make sure I'm going to get us where we want. Yeah, we're going to go 27 minutes into the press conference. First question is going to be from Rachel Siegel. She's from WAPO, and let's hear the question, and then we'll get Powell's response, and we'll react.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that, you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise, in the sense that it's not really telling you anything. You're trying to extract a signal from that. And the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero. And you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know in a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what in your mind would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which by the way has been behaving well. Which for some time
Thank
was
you, Powell. Finally,
kind of our problem. Now it's
finally
slow, but it's definitely moving down in a very good way. It's more now with goods and to some extent with non-housing.
Finally, we got Jay Powell to admit that housing service inflation is behaving well. Well, I'd love him to admit that real time rents are far lower than what we're seeing show up in some of this inflation data, because we know from places like realtor.com and other sources that are tracking real-time rents, they're actually going lower, year over year. And a lot of times month over month, we're getting lower readings. So, but the problem is they're getting year to 2 year old data because they got to wait for a whole entire lease to end. They meaning the Federal Reserve. Going to the tariff stuff, he said at a lot of points in this press conference, like, we believe that the tariff, any inflation on tariffs is going to be transitory. One of the reporters jumped on him when he said that, like, transitory, like the last time you said that inflation went through the roof. He goes, no, the last time we had tariffs, which would have been obviously Trump administration 1.0, inflation was transitory at that time. And so that's what he was talking about when he said transitory. The Fed's point is you're going to have some disruption. This is one of the things that obviously the Trump administration is saying as well. Like, you're going to have some disruption right now over tariffs. Like, he's not backing down, President Trump or the administration. They're not backing down from moving forward on tariffs. After the Fed meeting, Trump tweeted out this: the Fed would be much better off cutting rates as U.S. tariffs start to transition their way into the economy. Trump's been talking a lot about, signaling to the economy, signaling to, the American citizen that there is going to be a transition period. He said, don't watch the stock market for the future. Don't watch the stock market in the short term for the future of where our economy is going. President Trump calls on Jerome Powell and the Fed to do the right thing. April 2nd is that day that a lot of these tariffs come in. Now, what the Fed is viewing tariffs as is a transitory, increase potentially or impact on inflation. That's what it was last time, and that's how they're viewing it now. They have factored into their projections, as I mentioned before, full retaliation on tariffs. So, Jerome Powell said it multiple times yesterday that like we just don't know. This could be really good. The overall long run outcome on tariffs, it could be potentially not so good. So, he's left the door open for basically, what everybody's saying. And you can't find an analyst that can really pin down what's going to happen with tariffs. He's left the door open for like, hey, this administration could nail this thing, and this could be one of the best things long run for the American economy and the strength of the American economy, or it could create other issues, right? So you're seeing both sides. Let's go to the next question. that we've highlighted here, which would be from Simon from The Economist. Let's go to the question.
Not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today, you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunging confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean, the point is we are at, we're at a place where we can cut, or we can hold what is clearly a restrictive stance of policy. And that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard. And in the current situation, I just think uncertainty is remarkably high.
And sorry.
Okay, there you go. That basically sums up everything that Powell signaled to markets yesterday. By the way, the markets responded favorably. At the end of the day, you had a bump up on equity markets are like, wow, so you had to bump up on the equity markets. You had a 10-year go down. It's great for us. We're going to start getting into that right now. But the punchline is Powell says, I don't know of anyone, meaning analysts, who has a lot of confidence right now in their forecast. And then he just thinks uncertainty is remarkably high. This is good news for us. We want a level of uncertainty right now, being that we are, all in focused on housing. We want a level of uncertainty right now without going into any type of full-blown recession. This might be, it's spring market. This might be the perfect storm at the perfect time for a housing market that's coming out of a housing recovery. Okay. Logan, by the way, little first time I'm saying it, next Friday, Logan will be on Knowledge Brokers podcast. I got a whole bunch to ask him about with the mortgage industry and all of that. The next two guests are going to be really influential on some of these mortgage topics and how it impacts housing. Logan next week, Knowledge Brokers. Make sure you subscribe to that YouTube channel so you don't miss it. He was on Squawk Box CNBC this morning. Any uncertainty in the economy and economic growth slowing down is actually beneficial for housing as the 10-year falls. Haley, let's go to the first. I pulled a couple of clips here from this. Let's go to the 30-second mark with Logan on Squawk Box. This is good news. What's happening here in the last 24 hours and really in the last couple of months, what's happening as it relates to maybe the best conditions we could see with all things considered right now in the housing market. Let's go to Logan here, 30 seconds in.
Oddly enough, the 10-year yield dropping, mortgage rates falling, purchase application data for most of the year is positive year over year. Now, we're working from extreme low levels, but any uncertainty in the economy and economic growth slowing down is actually beneficial for housing as the 10-year yield falls. So when we think about tariffs and lumber, that's more of the new home sales sector. But for the existing home sales market, which clearly the White House, Treasury Secretary Bassett and Bill Pulte want to see grow, bond yields going down, just needing the mortgage rates to 6%. You can grow sales. I think the White House will be very happy with that this year.
All right, stop it right there. The administration's plans, what the administration is doing, he just quite frankly said the tariff stuff, the uncertainty around that hurts home builders. What the administration wants to see is existing home sales go up, which helps agents, attorneys, loan officers, cleaners, handymen, appraisers, inspector. Like it just, boom. The list goes on and on and on. It pumps movement into the market. When you have mortgage rates go down, more people can refi and do different things. When you have 30-year fix, more people can buy. The administration, Scott Bassett, Secretary of Treasury, these this mindset here is we want a 10-year to go down, which is going to bring the 30-year fixed rate down and bring existing home sales up. The actions that they're taking are hurting builders, 9+ months of inventory right now. The uncertainty and the confidence in the builders are low. That'll just go up if these rates come down, and it's going to help them too. But what we're seeing here is they want existing home sales to move up. Confidence in where most of Americans' wealth is, their house, they want to see more fluidity into the market there. Let's go to the next timestamp that I pulled out here from Mohtashami on Squawk Box.
Fall down like it has for the last few years. The builder sentiment tends to increase even with other headlines. So the cure for tariffs is lower mortgage rates, and this is why the White House wants the 10-year yield to go down.
The flip side, though, or the reason why mortgage rates are going down is important too, Logan. And some might say that the 10-year yield is going down because there are concerns about growth in the United States. The Fed just raised its expectations for unemployment. We've seen in the soft data, University of Michigan, for instance, consumer sentiment is at lows. And so I'm wondering, how do you sort of factor in weigh, okay, we got rates lower, but the consumer is feeling less confident about the security of their job and economic growth?
So during COVID, 25 million people were unemployed. It was a global pandemic. We had 5 million in forbearance. We had stimulus, but the 10-year yield collapsed and mortgage rates were at 3%. There's over 162 million people working because existing home sales are at the lowest levels ever when you adjust it to the workforce. It doesn't take much to move the needle from here. Very similar to the 1980s, early 80s, when affordability was worse. There was a recession early in the 1980s. Home sales were depressed. Mortgage rates fell down 2.5%. Sales started to pick up. So the housing market still revolves around the 10-year yield. We still have a lot of people employed because sales are so depressed. Mortgage rates going down for good or bad reasons will override any of the economy headlines just to get that bounce in sales. Very similar to what we saw in the early 1980s.
And that's exactly what we're seeing right now is a 10-year over the last 3 months that it's at its lowest level in 10 months. We've actually seen it a little bit lower here today. We saw 4.18 as recently as like 5 minutes ago. We're at 4.20, lowest level in the last 3 months. Certainly back at the low over the last 30 days. This should impact the 30-year fix today. We might even get under 6 3/4. The cure for tariffs, Logan Mohtashami says, is this lower 10-year yield, and that's going to push down the 30-year fix. Yesterday, the 30-year fix did come down a touch. We're at 6.76 on the 30-year fix off of 6.78. I actually think this gets under the 6 3/4 today with where we've seen the 10-year drop after those Powell statements. You want all of the data, obviously, to be able to pull and have the conversations with your clients and your consumers. Just jump into school, BAMX inside of school, and grab that. The big takeaways for me is what I've been talking about all week. We're talking about a perfect storm right now. High page views on homes. The highest we're going to see is the next 6 to 8 weeks. So you want attention on a listing, you've got a full auditorium. This is as full as it's going to get. You have standing room only over the next 6 to 8 weeks in terms of people paying attention to your listing. You have the least amount of competition you're going to have when you compare today until, to June. Competition is only going to go up, meaning, if we jump back into BAMX real quick and we go to Monday, okay, and we just look at inventory. Okay, competition has been flat all year. Now it's about to start doing that upward dance that we see in any other, year. We're looking at 2019 right here on the top. And over the next 3-4 months until you get to June, July, it is going to competition, homes competing, inventory is going to skyrocket up. It does it every single year. Okay. 2020, you just take out of anything because 2020, we were locked in our houses at this time and changed everything. 2020, not a comparison. Every other year, you can go back 20 years in your MLS and you see the numbers move up this time of year. Competition is about to move up this time of year. And so you've got standing room only on attention. People are shopping now, not in July. In July, they're barbecuing. They're drinking high noons. They're doing their summer thing. They're shopping now so they can enjoy the house in the summer. Standing room only, attention now. Least amount of competition you're going to see all spring right now. And you have the benefit of all this uncertainty that's going around, driving down the rates to the lowest level we've seen in 4 months. So 30-year fixed rate means the buyers competing for your home have more money, have more flexibility with what they can do in an offer. The perfect storm is upon us. Take advantage. Do not let any seller who's telling you, I think I'm going to wait 2 or 3 months, not see the 3 or 4 slides inside of BAMX that I just showed you. Do not let a seller not see those. Don't just give them the words. Don't give them the words. If I was them, I'd make you a chef salad if you were just giving me the words. Show them the proof. Show them the data. All right. One of the other things that obviously Jerome Powell mentioned here is there are some early signs that, unemployment could tick up. He was asked about DC. He says, listen, DC is not, some regions or neighborhoods or whatever, like these government layoffs might impact somewhere in Maryland or Delaware or, DC, like it might impact a neighborhood or a street or a building or whatever. These government layoffs that are certainly happening with Doge efforts. But he said, when you look at this nationally on unemployment, he goes, it's kind of just like, it's not even a thing. They don't consider it. It's not something that's going to have any impact on national numbers. That's what Jerome Powell said. He did say there are early signals that, has him and the committee believing unemployment is going to go up throughout the year from the 4.1 up to all the way to 4.4. We saw that in the projections. So let's get our first unemployment reading since the meeting, which came out this morning. Okay. Department of Labor had this released at 8:30 a.m. Eastern. And for the week ending March 15th, initial claims was 223,000. The target was 225,000. So actually it came in lower than the target, which we were expecting. It's an increase of 2,000 from the previous week's level. Anything over 250,000, that's when you start to see, some red flags here, or, some indication that unemployment's really going to move up. When we're sitting at these levels that we have been sitting at for quite some time, there's really just nothing to talk about. So just another report here where the job market continues to have evened out from those peak levels of where, you had a lot of openings and, you had a job market that was concerning to the Fed. It's evened out. It's been tampered down, but you're still not seeing a ton of data this week that suggests, obviously, it's moving up significantly here. Now, there are some analysts that believe some of this early data does suggest you could see unemployment move up. The uncertainty, creating, some companies to hold off till they get on the other side of expansion, on other side of uncertainty with expansion or whatever. And then some companies even maybe to start to really have some private companies have some significant layoffs. And then also the other theory is like, what is, the contractors? It's not so much the government employees. And that's what federal Chairman Powell said. The government employees aren't going to impact unemployment, but how about all those contractors that are being kind of supported by some of these federal employees? How deep are those cuts going to go, and what impact obviously that has? So there's some belief that unemployment could move up very quickly. Obviously the committee moved their target up as well. So there you go. There's your whole breakdown. You can grab more on this as well as some of the data that I covered here on Monday. That's very useful. This data right here, we're going to have, by the way, for BAMX members, when you check out new this week tomorrow for social media templates, we're making the social media templates on that high views right now, least competition, very consumer friendly, made for social. So make sure you grab those tomorrow. Those are going to be, made for social. This is kind of just the straight data that we dump in here on a daily basis. But I'd be using this stuff, certainly Monday stuff. And then you've got all of today's data in here to relate it to the uncertainty. The guy that is supposed to, know what's coming has no idea what's coming. That's why if you're selling a house, I'm doing it now, not the end of the year. Yeah, I want to get the highest price possible. I'm doing it now. Everybody should be listing now that is thinking about 2025 as a sale. There's just too much uncertainty as proven by the Fed. But all of that data, as well as our hot sheet show notes, how we make the cake, all available in there for you inside of BAMX. Go to school.com/BAMX. I'm sorry, Will. My apologies to you. Long hot sheet today, just a lot to cover. And you can find more if you still need more information, obviously at your fingertips inside of BAMX. We sifted through all the BS for you and left you exactly what you need at the time you need it. All right, there you go. There's your hot sheet for today. Hope everybody has a great Thursday. There'll be a walkthrough later on here on the main channel at Now Bam. Subscribe to the YouTube channel right down below. It's the best way to support us for absolutely free. And you get great content each and every day. Tomorrow, Knowledge Brokers Podcast, special guest, going to be talking about Fannie Freddie conservatorship, going to be talking about, some of these big movements that the mortgage industry has in real estate the week after. I already teased out to you, Logan Mohtashami coming on. Make sure you subscribe to Knowledge Brokers Pod. We've got a couple really big episodes up ahead. You thought last week's was big. These next two are even bigger. Can't wait to see you guys over there. We'll be back on the hot sheet on Monday, 9:30 on the East, 6:30 in the West. Until then, of course, toodaloo.